Whatever brought you here today, stay with this video for a few minutes. Because when people ask, how do I know whether a stock is actually worth buying, they often begin with the wrong question. They look at the share price, compare it with an earlier price, examine recent headlines, or search for a number that tells them whether the stock is cheap or expensive. A better question is more fundamental: what economic value does the underlying business have, and how much of that value is already reflected in the price? That distinction is the foundation of stock valuation. A stock price is observable. Business value is an estimate. The price tells you what the market is currently willing to pay, while valuation attempts to determine what the future economic benefits of owning the business might reasonably be worth today. But why is valuation so difficult if financial statements provide so many numbers? Because valuation is not primarily a mathematics problem. It is a future expectations problem. Revenue, profit, operating cash flow, assets, debt, and margins describe what has happened or what currently exists. Valuation asks what might happen next. How quickly can the business grow? How much cash can it ultimately generate? How much capital will that growth require? How durable are its competitive advantages? What happens if the economy slows? And what return should an investor demand for taking that uncertainty? This is why two intelligent investors can study the same company and reach different valuations without either person necessarily making an obvious mistake. Consider a simplified example. Imagine a business generating 100 crore rupees of annual free cash flow. If an investor believes that cash flow can grow steadily for many years, the business may deserve a much higher valuation than if that 100 crore rupees is close to its sustainable maximum. The current number is identical, the interpretation of its future is different. That leads to one of the most important distinctions in investing. A wonderful business can still be a poor investment if its price already assumes too much perfection. Conversely, a business facing temporary difficulties can sometimes become attractive if the market price reflects a much worse future than the underlying economics justify. So how can an investor determine whether a stock is undervalued? There is no single formula that can guarantee the answer. Instead, several valuation approaches can provide different perspectives. Earnings multiples compare price with profits. Price to book ratios compare market value with accounting net assets. Enterprise value based measures consider both operating value and financial obligations. Discounted cash flow analysis estimates the present value of future cash generation. Each method answers a slightly different question. A discounted cash flow model, for example, forces you to confront assumptions that investors sometimes prefer to avoid. What will revenue growth look like? What operating margin is sustainable? How much reinvestment is necessary? What will happen to cash generation after the high growth period? What discount rate appropriately reflects risk? The uncomfortable truth is that a valuation model can produce an impressively precise number while still being wrong if its assumptions are unrealistic. This is why margin of safety matters. If your estimate of intrinsic value is 500 rupees and the market price is 490 rupees, you may have very little protection against an error in your assumptions. If the price is substantially below your carefully reasoned estimate, the gap can provide some protection against uncertainty, but it never eliminates risk. This also explains why stock valuation should not be separated from cash flow. Accounting profit can be affected by depreciation, working capital movements, capital expenditure, and other accounting considerations. Cash ultimately determines how much economic value a business can distribute, reinvest, or use to strengthen its balance sheet. Artificial intelligence and automation make this analysis even more important. Technology can dramatically increase productivity, reduce certain operating costs, create new markets, or make existing business models less valuable. Therefore, historical growth alone may not tell you whether future cash flows are durable. The investor's real task becomes distinguishing temporary growth from economically sustainable growth. Psychology complicates valuation further. When a stock rises rapidly, investors can become anchored to recent prices and assume the business deserves continued optimism. When a stock falls sharply, fear can make investors assume deterioration must continue indefinitely. Both reactions can confuse price movement with fundamental value. This is where disciplined thinking becomes more valuable than prediction. Lord Hanuman offers a powerful framework for this kind of discipline. His strength was inseparable from wisdom, humility, service, and devotion. Applied to investing, that means having the courage to question your own assumptions, the humility to admit what you cannot know, and the discipline to distinguish evidence from emotion. The Bhagavad Gita similarly reminds us of the importance of disciplined action without becoming consumed by the outcome. In investing, you can control the quality of your research, the assumptions you make, the risks you accept, and the price you are willing to pay. You cannot control what the market does tomorrow. So perhaps a better way to understand stock valuation is not to ask, what will this stock price do? Ask instead, what must be true about this business for today's price to make sense? That single question can transform valuation. If the price requires extraordinary growth, permanently expanding margins, minimal competition, and flawless execution, you are not simply buying a business, you are buying a demanding set of assumptions. If the price appears pessimistic while the business possesses durable cash generation, manageable financial obligations, productive assets, and a credible path toward improvement, the investment question becomes very different. This is the essence of stock market engineering, breaking a market price into its underlying economic assumptions and examining whether those assumptions deserve your confidence. You do not need perfect prediction. You need better questions. You need the patience to study cash flows, the discipline to test assumptions, the humility to recognize uncertainty, and the courage to walk away when the price does not provide enough protection. And that is where gratitude changes the investor's mindset. Gratitude reduces the pressure to force a trade simply because an opportunity appears. It creates patience. Patience creates better observation. Better observation can lead to better decisions. With the wisdom, discipline, humility, and inner strength represented by Lord Hanuman, stock valuation becomes more than calculating numbers. It becomes an exercise in seeing clearly. The market will always offer prices. The real question is whether you can look beyond those prices and understand the economic reality underneath them. Because the goal of valuation is not to predict the future perfectly. It is to make better decisions when the future cannot be known. Jai Hanuman.